Welcome back. A rough day for tech, as you know. So when can we expect that trade to stabilize? Let's ask Ed Yardeni. He is president of Yardeni Research with me once again at Post 9. Are you thinking a lot about that as you look at this tech trade, wondering like what's actually happening here?
Well, December 7th, we decided to rebalance our recommendation. We actually recommended underweighting the Magnificent Seven. We thought that there was just going to be too much competition as a result of all the money they were spending on data centers. And we also went overweight going global instead of staying home. So those things have worked out pretty well. I think they have a ways to go. I think it's actually very healthy for a continuation of the bull market. It's not a lot of fun for those who are still overweight the Magnificent Seven.
I know there are questions, though, as to whether that rest of the market trade is a little long in the tooth.
Right.
And, I mean, if it is, and then you have weakness out of tech, you're gonna have a market problem.
Yeah, they get out of Dodge trade, get out of the Magnificent Seven, has basically been around since late October, when Michael Berry kind of raised some relevant questions about the profitability of these companies. The rebalancing overseas has been going on since the beginning of last year. In the grand scheme of stock market history, that's really fairly new kind of developments.
What does it tell you? Because, I mean, you've seen so many markets, Ed, and you've written about so many periods of time, too. What does it tell you when you see a market that is so quickly driven and swayed by a obscure research report or, you know, a projection about something that might happen? Does that tell you anything, make you feel a certain way about the market you're watching? Yeah,
I mean, it clearly, with the benefit of hindsight, indicates that the euphoria on AI wasn't sustainable, and it turned into AI fatigue, and now it's AI fear. It's almost kind of AI derangement syndrome. I mean, people have kind of gone off the deep end about how this is going to create major job losses and all sorts of other dire predictions. I think these are all extremes. I think AI is a great tool. I think we're all going to be using the tool to make ourselves more productive. I see this as net a positive, but the market right now is going through all sorts of mental gymnastics.
Well, I mean, look, you know, obviously software is the epicenter. The biggest, you know, declines in that space, I think the financial crisis is like 30-something years. Is that overdone?
Yeah, I think it is overdone to a certain extent, but in this case, you got to be a stock picker. I don't know that you buy an ETF of software stocks, because some are not going to make it, and others are going to make it very, very, very well. So, given that there's a lot that we don't know how this all plays out, why not go with the flow and go into energy, materials, consumer staples? Those have all done well, and of course the overseas trade. I mean, you've talked about what's going on in Korea and other markets.
But you know, energy is a small piece of the market. It's tiny.
It's not hard to overweight.
Staples have done really well.
Yeah.
Maybe they're too expensive.
Yeah.
I mean, those aren't areas of the market that are going to make you feel like, oh, okay, I'm going to lean in there, and I think the S&P can have a really great year.
I think, you know, financials is certainly a place that's been beaten down of late because of the AI fears. But as Jamie Dimon, CEO of JP Morgan, explained, that he expects that they will spend $20 billion in 1 year on technology, specifically AI, and that net it's going to be a big productivity booster. And I think a lot of financials are going to be like that. The regional financials, I think you're going to see benefit from AI, but also benefit from M&A.